Look, we've got long-term geopolitical things going on here. This is not just going to be about short-term moves in the market, but they're really powerful forces sweeping through market dynamics here as well. There's simply not enough liquidity right now to sustain China's market where it has been even this year, beaten down as it has been. And now on top of that, you have a lot of additional risks that are being laid down, and people are reacting to that. So we're going to have volatility for some time now. It's going to take a while to reestablish a sense of...
Let's talk about the liquidity first. Why not enough liquidity here? It's because investors are concerned about what they've seen from this regime? Partly
it's a war of choice that Beijing is pursuing for the right reasons. They've been deleveraging, trying to drain their swamps of shadow banking activity that was underregulated, was systemically risky, and so they've done a great job of taking wealth management products out of the market that shouldn't have been there in the first place. The problem with that is they've taken the legs out from under demand. So they're trying to reestablish those channels of demand into the equity markets, allowing banks now to start offering their own wealth management products, for example. But that doesn't happen overnight. Banks don't want to take risks for the same reason that shadow banks shouldn't have been taking them in the first place. So it's not a quick swap out.
Wealth management products, WMPs, we talked about them for so long, they've been problematic for so long. The market in China rallied dramatically yesterday based on all this job owning that happened over the weekend and late last week. Did the Chinese authorities actually say anything meaningful that could support the market, and is that why the sell-off is happening today? I mean, what can they do at this point if they wanted to turn things around?
Well, look, I mean, you build up credibility over years and years and years, and that credibility means that when City Hall says, we're going to stabilize the market stabilizes. And that's great until it doesn't work any longer. And your markets grow to a certain point where it's no longer possible for political officials to simply say, it shall be stable, and it will be stable. China is now no longer a $2,000 per capita economy. It's a global juggernaut of extraordinary size with the largest banking system on the planet. And you just can't run it that way anymore. So they like it to be stable, of course, but there's all these things in the mix now that weren't there a year ago. Deleveraging, trade war with the United States, fundamental slowdown in the Chinese economy that's going to require repricing.
Dan, very quickly, who has more to risk from this trade war? Is it China, the United States, or both?
Well, I think probably it's China, right? Because China still has the furthest distance to go. If the U.S. kind of stagnates and goes sideways, we're stuck at $40-some-odd thousand per capita income. China is several generations behind where we are as a society, and the people aren't willing to sit still. They need that growth in order to hold the consensus and support around a one-party government together. So China's got kind of like a bicycle. If it doesn't keep moving forward, it's going to tend to fall over.